Okay, so we're going to do some exercises from chapter 15. There's 4 exercises I'm going to work on today. And the first one is 15.1. And so I tried a new deal where I'm just doing on a PDF and adding some data. So we'll see if that works better, since I can't really get it to jive otherwise. So let's try this. So this problem is Dion, an S shareholder, owned 20% of Meadowbrook stock for 292 days and 25% of the remaining for the remaining 73 days in the year. So this is that thing where we have to prorate how much we're showing as each of the different types of income that are flowing out on the K1 to the shareholder whenever there was a change in their ownership. Okay, so we're going to use the required per day allocation. And so we have ordinary income on the Schedule K of $60,000. And then we have tax exempt interest of $1,000 that's going as a separately stated item. And then charitable contributions at $3,400. That's also a separately stated item. So we're just going to split each one of them based on the methodology that they showed us in the book and the little exercise they did. So for ordinary income, we're going to take that $60,000 times the 292 days divided by 365. And that's going to bring us to 9,600, I think. Then for the tax exempt income, I'll just go ahead and put it on the next line. Oh, yeah. And then for the next, that was the 20%. Oh, I'm sorry, I left out the 20%. 60,000 times 292 days divided by 365 times 20%. That's what brought us to 9,600. And then we would have our 60,000. I think I'll just copy this down and change the percentage to 25. And it's not 292 days, it's 73 days at this 25% ownership. So if you multiply the 60,000 times 73 divided by 365 and times the 25% that he owned for the last days of the year, well, I think we're going to come to $3,000 for that, not 2,000. So the total that we're going to call ordinary income is the combo of the 9,600 and the 33,000. So that puts us at 12,600. So that's what they want right there. For ordinary income. And then we'll take the tax exempt and do the exact same process. So we're using the, instead of 60,000 for tax exempt, we're going to use the 1,000. So of course we're going to get a different result. So instead of 9,600 and 3,000 and a total of 12,600, since it's tax exempt, we're going to be using, I'm going to copy this down while I've got it here, bare bones, so I can use it for my charitables. So the tax exempt was 1,000 times the 20% times 292 days of the 365, which I calculated to be $160. Then when you take the 25% ownership, that's only for 73 days, multiplying 1,000, which is tax exempt interest, times 73 divided by 365 times the 25% ownership for that part of the year, I think that's going to put us at $50 for that period of time. So then when you combine 160 and 50, you're going to come up to 210. And that's the answer they want for tax exempt interest. Okay, so let's see what else we got. Now we're going to take for charitables, it's 3,400. So same process. Take the 3,400 times the 292 days times the 20%, and then take the 3,400 times the 73 days and 25%. So at 20%, 292 days of the 365, $3,400 would be $544, I think, that's what I count. And then when you calculate 3,400 times 73 divided by 365 times the 25% for the last piece of the year, you wind up with $170 as the amount. So when you combine the two, the 25% ownership and the 20% ownership, you get a total of $714 for the charitables. And for some reason, I have charitables twice. Don't ask me. I have no idea how that happened. But it's just insistent that we should have it that way. Okay. I'm just trying to put a space between it, but it's just saying no. So that's what we got. Copied too much probably a moment ago. But anyway, you get the point. It's just my formatting has gotten a little garbled because I have something else on top of it, but still get the point. The answers 12,600, 210, and 714. So ordinary income, the K1 for this shareholder, for Dion, for ordinary income would be 12,600. Then for tax exempt would be the 210, and then for charitables would be the 714. All right, so that's 15.1. Then for 15.5, we've got K1 Inc., a calendar year SCorp, partly owned by Sherrod, whose beginning stock basis is $32,000. During the year, Sherrod's share of the K1 long-term capital gain is $5,000, and his share of the ordinary loss is $18,000. Sherrod also, or it says then, but we have to consider it first, actually, but he then received $20,000 in cash distributions. So we have to, in order to calculate the adjusted basis, we start with this beginning basis of $32,000. Then we reduce it by his distribution, $12,000. And that means he had adjusted basis after his distribution was accounted for of $20,000. So of that, no, not 20,000, sorry. He had distributions of 20,000, which left him with an adjusted basis of 12,000. I'll get it right eventually. Just sometimes takes me a minute. All right, now there we go. So his adjusted basis is $12,000 when you just consider his beginning basis and his distribution. And so then you look back at the problem, you say, okay, his beginning stock basis was $32,000. He had a long-term capital gain of $5,000. So what we're going to do is add that gain to his basis to see how much does he have that he could deduct a loss with. So we add that gain in, and that brings us to adjusted basis with the gain of $17,000 before he starts deducting his loss. The loss is $18,000, but he can't take it all because he's limited to the amount of his adjusted basis from these other things. So for the A part, they're asking us how much can he currently deduct, and we're saying he's limited to his basis, so he can only deduct $17,000. Then they want to know how much his suspended loss is, and we say it's the other 1,000. And so 17,000 is the amount he can deduct. 1,000 is suspended because he didn't have enough basis to deduct it. And then what is his new basis in the stock? And we know that means his basis is 0 because we just used it up for this loss. Okay. So that's all they wanted. The current year, 17,000, the suspended loss, 1,000, and the remaining basis, 0. All right, then 15.14 is the next one. The profit and loss statement of Kish Limited and S Corporation shows $100,000 book income. Kish is owned equally by 4 shareholders, and from supplemental data, you can obtain the following information about items that are not included in book income. So the first thing we have to do is convert the book income to tax income. So how much should be ordinary income? How much should be separate stated? So we're going to pull down the ordinary income, non-separately stated income as it would have been on the tax return. So the first thing, we look at all this information and we say, which ones affect what? And so book income would have included this capital loss. So the first step we're going to take is we're going to add that capital loss in. Oh, I guess I could put the amount first since that's the format I have here. So that would put us at 106 subtotal. Okay, and then we're going to remove the separately stated items to get to the ordinary income. Because the question they're asking us, the first one is, what is his non-separately stated income or loss, which is the one they call ordinary income. Okay, and so we're going to remove the separately stated items. So we know we would have to take out, to get to his ordinary income, take out the dividends because it's separately stated. $9,000. Take out the tax exempt because it's separately stated and not taxable. Take out the code section 1231 and get to my symbol at the moment. So I'm just going to put CS for code section 1231, which is that the capital gains on the real estate. And so that's separately stated. And it was a gain. All these are income items that we're removing from this subtotal of income in order to get to ordinary income. And then the last one is the $5,000 passive rentals. So that would be 9,000 plus 3,000 plus 7,000 plus 5,000. So that would be 10, 19, 24,000 that we're subtracting out of this total in order to get to the ordinary income. And so that would leave us with 82,000 ordinary, or also known separately stated, non-separately stated. Okay. Okay. So we're 82,000 is the first answer they want. They, for A, 82,000 is what they wanted. So because they ask what is the separately stated income for the whole corporation, the entity's non-separately stated income or loss. And so that's what we just did. We computed it. Then the next thing they asked us was, what would be the share of this year's non-separately stated income or loss that for James Billings? Well, they told us, that's one of the shareholders, they told us they owned equal shares. So we're just going to take that 82,000. Divided by 4. And that's going to bring us to, what is that, 20,250? No, 20,000, 20,500. Can't subtract, can't divide, because too many calculators and tax programs and all kinds of things that cause me not to be as good at calculating as I used to be. All right, and then C, they want us to say, what is his share of the tax exempt interest, if any? So again, tax exempt interest was $1,000. It's going to be a separately stated item, and it's calculated by dividing by 4. $3,000. Put the K for the 1,000 divided by 4 equals $750, right? That's all they want. They want you to say for A, separate stated income is 82. For B, his part of it is 20,500, and for C, his part of the tax exempt is 750. That's it. Okay. Then the last one we'll do is Orange Inc. This is number 1526 in your textbook. Orange Inc. is a calendar year corporation in Clemson, South Carolina, that elects S corporation status for 2022. Company generated a $74,000 NOL in 2021 and another NOL of $43,000 in 2022. Orange stock always is owned by the same 4 shareholders, so no changes, each owning 25%. Pete, who's one of the shareholders, holds a $6,020 basis in this orange stock at the beginning of 2022. Complete the statement below that outlines the federal income tax issue that Pete faces. So the first piece says, in 2021, C Corporation NOL of $74,000, and they want to know, does it carry forward into the S Corporation year? And does it? No, because it is the shareholder that decides whether to deduct or carry or what to do. So it does not carry forward. It's not part of the S Corporation future. It is only related to the individual and depends on whether they can deduct it or not, or whether they have to suspend some of it, which would be the equivalent of carrying forward. Okay, so that's the first piece. Then, therefore, it does not carry forward. So therefore, the deductible loss in 2022 by Pete is however much he can deduct in that year, which is limited to his basis. So it's not complicated whatsoever. It is just 6,200 in 2022. And the suspended part is the remaining piece of his loss, 4,000. I calculated this already to be 4,730. So between the two of them, it is 10,930 that his share is, but some of it is not deductible in this year. Oh, I got this number wrong. So it's not 7. Let me do my calc again once I get these numbers correct. His deductible loss is his basis, which was 6,020, and his carryover is 4,730. So the two of them together, 10,750. So when you took the current $43,000 NOL for 2022 divided by 4, you'd be at 10,750. So that's exactly what he did. His part was 10,750. What's his name? Pete's part of 2022 loss equals 43,000 divided by 4, which is 10,750. And of that, 6,020 is all he can deduct because his basis limited him, and the rest of it goes forward. So if he establishes some basis in the future for that, he can offset it. Okay, and that's all. So we're going to do this time. Thanks. It's a little messy with my new technique, but it's okay. We survived.